Hello everyone. Welcome to video 7 of chapter 7. In this video, we're going to go through the slides around dividend income, and we're going to do the exercises for both eligible and non-eligible dividends. So let's jump into the slides and get going. So dividend income comes when you receive after-tax money from a corporation. So dividends get included in income of shareholder when received, when paid out. The declaration date of the dividend is irrelevant. The dividends need to come from a taxable Canadian corporation because that dividend income is going to do its gross up and get a dividend tax credit. And what you're doing is you're recognizing the taxes that Canada has already collected from that income. So this treatment's dealt with for dividends of Canadian taxable corporations. Dividends do not have to be paid in cash. There is a concept called a stock dividend, which is on a slide later, where they give you instead of giving you $100, they might give you $100 worth of stock. You're still receiving $100 of value, so the calculation's treated the same regardless of whether they give you cash or give you something other than cash. It doesn't have to be paid, but its comparative value is still included in income. And dividends are taxable dividends. There's another slide on capital dividends, which I will discuss after we get through this calculation here for eligible and non-eligible. So we have a couple steps. When an individual receives a dividend, that dividend is an after-tax amount. So the first thing we have to do is we have to gross the dividend we received back to its pre-tax number. So the dividend gross up from the individual taxable Canadian corporation are grossed up or increased by the amount that reflects the expected income tax that's paid by the corporation. You have an after-tax amount. The gross up will add back the tax to get that pre-tax income. Then you will calculate your taxes owing normally, but you get a dividend tax credit for the taxes already paid by the corporation. So the individual calculates their tax payable based on the grossed up amount, and the dividend tax credit applies against the individual's gross taxes equals the approximate amount of corporate income taxes paid by the corporation. So it's saying based on this income, you owe a set amount of taxes. Part of it's already been paid by the corporation. You just need to pay the difference. So this is an image that's supposed to show the concept of integration. So if there's an income source, if you earn it personally, you're left with a certain amount of money. If you earn it through a corporation, you should still be left with functionally the same after-tax return. That only occurs in perfect integration. So mathematically, there is a tax rate and a dividend tax credit rate that should perfectly balance these two paths. In practicality, we don't really have perfect integration, but the concept still applies. We want income sources to be the same, whether an individual earns them personally or through a corporation as a shareholder. So the problem with achieving perfect integration is it's difficult to apply a specific gross up and specific dividend tax credit numbers because corporations are subject to different tax rates. There's different tax rates in federal and provincial income tax, and different types of corporate income is subject to different income tax rates. Corporations that earn passive income or their own property income will be taxed at slightly different rates than business income in a corporation. Different provinces apply different tax rates. So because the tax rate that any individual corporation is subjected to, in order to achieve perfect integration, our gross up rate would have to be just as varied. And that would make the process incredibly cumbersome and incredibly complicated. So what they try to do is they take the collection of most common tax rates and they've sort of bundled them into two gross up rates. There's eligible down here, eligible, and non-eligible. Do we go into it? Yes. So um, eligible dividends apply the general tax rate, the common tax rate mostly paid by public corporations in Canada. This is roughly 27%. So a public corporation pays a higher tax rate than a small business. A small business in Ontario pays a tax rate of about 12%, but a public company, a general corporation, they would pay the general rate of roughly 27%. So we have these two very different tax rates. So eligible dividends are dividends that are paid out of a higher tax rate corporation. A corporate income that paid a high tax rate or the general rate, they pay eligible dividends. Other than eligible or non-eligible dividends, they come from low income tax rate. Uh, the tax term for it is literally a low rate income pool. So eligible is the general rate. This is the high rate corporations. Income from Canadian public companies are subject to higher income tax rates than CCPCs. In Canada, this can range from 23% to 31%. In Ontario, we're 26.5% generally. This requires a gross up percentage of roughly 38%. So in our example I used in the last video, we calculated that to return the after-tax dividend to its pre-tax number was about 37% because of the tax rate we used. Eligible dividend uses a gross up of 38%. This is the rate that would apply in a perfect integration rate of 27.536%. So this general rate, or this assumed tax rate of 27%, is within the range of 23 to 31. So they sort of picked a general midpoint in the range, and that's what they've geared the dividend rules to. So eligible dividends is assuming a tax rate of 27.5%, and that requires a gross up of 38% to get it back to its original position. There are circumstances where CCPCs can issue eligible dividends. We're not going to go into that in this course, in these chapters, but dividends will be revisited in a later tax course where we will apply circumstances where a public company might issue non-eligible or a CCPC might issue eligible. For the current time, public companies pay eligible dividends. CCPCs pay non-eligible dividends. So eligible dividends have a higher gross up rate. Non-eligible dividends, because they pay a lower tax rate, their gross up just isn't as high. CCPCs in Canada have a range of taxes from 9% to 12.2%. So they need a smaller gross up to return them to that original income amount. So non-eligible are treated almost the same as eligible dividends. Instead of a gross up of 38%, their gross up is 15%. So that gets us step one. We've got a dividend. Step one is gross it back up, whether 38 or 15% to an income amount. We calculate taxes as normal, and then you get a dividend tax credit for the corporate taxes paid. So the thing about the gross up is it's assumed to be the corporate taxes, right? If I receive $73 and I'm adding back 27 to get to the pre-tax, that gross up portion is assumed to be the corporate taxes paid. Now, that corporate tax was part federal and part provincial. It's the combined tax rate the corporation paid. So the federal dividend tax credit is 6/11 of the gross up amount. So in our example from the last video, our gross up was $27. So the federal dividend tax credit is 6/11 of the $27. With the federal, there would also be a provincial or territorial dividend tax credit. Each province has its own dividend tax credit rate that they apply. Perfect integration would say their tax credit needs to be 5/11. I will generally say most of the provinces do not use this fraction. They just apply a general sort of 30% dividend tax credit rate, 35, etc. In the questions, we will give you the provincial dividend tax credit rate. We'll just say the tax credit for the province for dividends is 30%. So don't worry about the provincial, but you do need to remember the federal rate is 6/11. So this example shows the corporate taxable income, let's say it's $10,000. If we assumed that perfect integration tax rate of 27.536, they will pay taxes of 2,754, which leaves in the corporation 7,246 left. The corporation had income, paid taxes, that's how much is left. The shareholder wants the full amount, so they get paid the 7,246, and that gross up of 38%, when we apply it to the dividends received, will add back 2,754, which matches the taxes paid. That's the goal of the gross up, to add back taxes paid. So the taxable dividends are now $10,000. That's what you're getting taxed in your income return. If my personal tax rate is 51%, $5,100 is the taxes owing, but some of that 5,100 was already paid by the corporation. So we get a dividend tax credit. So the dividend tax credit, the federal portion being 6/11ths, plus a provincial portion of 5/11ths would make 11/11, which is 100%. So the tax credit is 2,754. The tax credit matches the taxes paid. The individual will pay 2,346 in their hand. So they received 7,246. They paid 2,346, means that they are left with $4,900. So it's kind of a complicated series of steps, but what it does is it gets us back to the same place. If someone had earned that $10,000 directly right in their pocket, they just pay the personal tax rate of 51%, which means they keep 49%. So $4,900 is left in their pocket. So having the corporate tax dividend goes through a number of steps: the gross up, the taxes, the dividend tax credit, but ideally will get us back to the same place as if we had earned it personally. So let's do the exercise for the eligible dividends. In 2025, Miss Holt resides in a province and receives a $15,000 eligible dividend from a Canadian corporation. Her income is such that the dividends are subject to a personal tax rate of 29% and 14.5% provincially. So 29 is federal, 14.5 provincially. Combined, Holt pays 43.5% taxes. The provincial dividend tax credit on eligible dividends is 30% of the gross up. Determine the total federal and provincial income tax that's payable on these dividends and her after-tax retention. So the eligible dividends, we're told that we received $15,000. The first thing we need to do is gross that amount back up 38%. 38% times 15,000 is $5,700, right? 15,000 times 0.38, 5,700. So we're adding that income back. That was taxes already paid. So the taxable dividends, the pre-tax income amount, is 20,700. We've added these together. So Miss Holt needs to report taxes on $20,000. Her federal rate is 29, provincial rate is 14.5. So combined, that's 43.5%. So if we take 20,700 times 0.435, the taxes owing is $9,004.50. We can round that to 9,005. So Miss Holt owes $9,000 in taxes, but the corporation's already paid some of those taxes, so we need to get a credit. For the dividend tax credit, we will apply 6/11ths times the gross up, plus the provincial refund rate, the provincial credit rate times the gross up. Whenever you're taking two numbers times the gross up, we can add those together. So 6/11ths comes out to about 55%. So of our tax credit, or of the gross up, 55% is going to come through as a federal tax credit. But we're also going to get a provincial tax credit of 30%. So to this number, 55% is coming through federal, plus 0.30 to add 30% to this number. So 55% credit for federal, 30% for provincial. Our dividend tax credit is going to be about 85%, 84.5, 85% of our gross up. So we're going to take this number and we're going to multiply it by our gross up number of $5,700. Our tax credit comes out to $4,819. So this 4,800 is roughly 85% of our gross up amount. So that's the dividend tax credit. We owe $9,000, but we are getting a credit for about 4,800, saying 4,800's already been paid. So this isn't perfect integration. If it was perfect integration, our tax credit would match the gross up amount. But because our tax credit's not quite perfect, we only get $4,819. So we owe $9,005. We get a credit for $4,819. So we will pay, or Miss Holt will pay the difference, $4,186. So Miss Holt received $15,000. She will pay $4,186 for her portion of the taxes, which will leave her with $10,814. So she received that much. She'll pay her taxes, and that will leave her $10,814. That's the amount she gets to keep and spend on whatever she likes. When you do this question on the quiz, they might ask you for what is the dividend tax credit. So you need to figure out how much is being subtracted from taxes. Or they might ask you what is the after-tax retention? How much money do they get to keep from their dividend? And for that, you'd want to go all the way to the end, find out the taxes payable, subtract it from what was received. So going to non-eligible dividends, just like how we have a smaller gross up of 15% instead of 38, the tax credit is going to be weighted more heavily towards federal taxes. So non-eligible dividends pay 9/13 of the gross up. We go through the same process. Perfect integration for non-eligible dividends would be 13%. So that's the assumed taxes. We get a tax credit of 9/13 plus 4/13 of the gross up. And hopefully that comes back to the same number for our dividend tax credit. It likely won't, because this is assuming perfect integration, which in practical terms, in the real world, we really don't have perfect integration. So our credit is always going to be a little bit off from our gross up. It goes through the same process. This is just the proof that we still come to the same number at the end of the day. So you can go through this in more detail. I want to go straight to the non-eligible exercise because our calculation is going to be done the exact same way. We're just going to use a different gross up rate and a different credit rate. So you need to remember 6/11 is eligible. For non-eligible dividends, in 2025, Mr. Johns resides in a province and he received $17,000 in non-eligible dividends from a Canadian corporation. His income is subject to a federal income tax rate of 29%, but the provincial tax rate this time is only 12%. So those combine to about a 41% combined taxes. The non-eligible dividend tax rate for the province is 30% of the gross up. What's the total federal income tax that will be payable, and what's the after-tax retention? So instead of $15,000, we receive $17,000. Let's go through the process again using non-eligible rates. So non-eligible dividends, the process is still the same, but you have to remember that non-eligible grosses up at 15%. So $17,000 times 15% is $2,550. So that's what we need to add back to that income we received. So our pre-tax income, the taxable dividends, is $19,550. We calculate our taxes based on this number. Our federal rate and provincial combine to 41%. So we owe just over $8,000 in taxes, $8,016. But part of it was already paid. So our dividend tax credit to recognize how much was paid is 9/13. So 9 divided by 13 is 69.23%. So about 69%. Our provincial credit rate is 30%, so plus 0.30 to add 30% credit to our total. 99.23%. So we're going to come very close to getting back to that gross up amount. So this 99%, here we go, is going to be multiplied by our gross up total times 2550 comes to 2,530. It comes to some cents, but we'll round it off. So we owe $8,016, but we're going to get a credit of 2,530, very close to our total gross up. But we still owe 5,046. So that's what we calculated as our entire payable. We got a credit of $2,500. We have to pay the remaining amount, $5,486. So we've received $17,000 from dividends. We pay $5,486. That's Mr. John's share of those taxes. So he will get to hang on to $11,514. That's his retention, his tax amount that he gets to keep. There's a couple slides here, comparison of investment and mutual funds. I'm just going to skip those because for some reason they're in between our stock slides. So stock dividends is when you receive dividends instead of cash. You still treat it as if you received cash. If they paid $10,000 worth of dividends or worth of stocks, you receive $10,000 worth of dividends. So it's treated exactly like cash dividends. Capital dividends are tax-free dividends. They come from companies that had a capital gain. So let's say the company had a capital gain of $10,000. Capital gains are only taxed or are only included in income at 50%. So half of it is taxable, half of it is non-taxable. So $10,000, the half that's taxable is $5,000. Because it's taxable, the corporation pays taxes. If this gets paid, so if this gets paid to a shareholder, that is a regular dividend based on their tax rate. So if that 5,000 was taxed at the general rate, it's an eligible dividend. If it was taxed at the small business rate, it's a non-eligible dividend. The non-taxable portion is $5,000. This amount was not added to the corporation's income. It's a non-taxable portion. So when they pay out this $5,000, this is called a capital dividend. The non-taxable portion of that capital gain stays non-taxable when it gets to the shareholder. Because remember, integration is the individual should be taxed the same whether they earned it personally or earned it through a corporation. So if I got a capital gain personally, half of that capital gain would not be taxed. So if I get paid the non-taxable portion of a capital gain, I also don't get taxed. Non-taxable in shareholders' hands. So that's the key detail about capital gains or capital dividends. Capital dividends come from the non-taxable portion of a capital gain. So the tax-free dividends, this achieves tax-free status if election is made to pay out of a capital dividend account. So every time a corporation gets a capital dividend, gets a capital gain, they have an account on their tax return that tracks the non-taxable portions. It's called the CDA. So if they want to declare a dividend and they have a balance in their CDA, they can say this dividend is being paid out of the non-taxable account, the CDA. So the shareholder can receive that cash and not pay taxes on it. So a corporation must first declare a regular dividend and then file an election to treat that dividend as a tax-free capital dividend. When they do, their CDA balance is then reduced because you're paying out of that account, that tax-free account. So when that CDA gets to zero, the rest of the dividends have to be taxable. Okay, so we're just short of 25 minutes. That is our video on dividends. The next video will be the last video. I'll go through a couple smaller details. You know what, on my next video, maybe I'll cover a couple small topics and then end it, and then we'll have a last video where I handle foreign tax credits, and then we'll be all done chapter 7. So thank you for your time. See you in the next video.